How has the shutdown hurt business, and how does it look from here on out if indeed we see the government start opening?
Hi, Carol. It's good to be with you today. Certainly, as we experienced the shutdown and around the middle of October, around the time when people in the District of Maryland, Virginia stopped receiving their paychecks, we did see a slight step down in spend in those markets. Certainly not anything acute, but certainly an impact that we noticed in the business overall. So as we look forward to hopefully a return to work in the near future, it's likely that it will have a benefit. But really what we're wanting to do more focused is on the long term and what that means for Cava to be able to provide incredible food, abundant offerings with amazing flavor that make you feel good while you're eating it and after. And we believe that relevance will continue to drive benefit for the business over the long term. The other thing to keep in mind is that we are anniversarying or lapping very strong same restaurant sales in the prior year, fourth quarter, at 21%. And so that is what's influencing our outlook for the rest of the year in 25. And as we go into 2026, looking forward to the culinary offerings that we have that we can bring to our guests every day.
Tricia, thanks for joining us again. Just wondering, in terms of your view of the consumer, we've seen restaurant chains, not just you, but also others, reporting weaker results and cutting forecasts. What's your view of the consumer from here? We've heard a lot about the K-shaped economy where sort of well-off people are doing well, but the weaker income bands are just spending less. Is that something that you're concerned about?
Certainly, you can see from the high frequency data with credit cards that the consumer is feeling some more pressure, as well as just the consumer sentiment in general. There have been a lot of challenges as the consumers are facing them in the near term. And as we experience those in our business, what we're finding is that consumers continue to lean into our premium items. So our amazing steak and our new chicken shawarma, as well as attaching with incremental items like our fan favorite pita chips. Right now, we've got cinnamon sugar pita chips with a drizzle of honey that's incredibly tasty.
I'm hungry.
As well as our fresh. I know. I had them for lunch today, so they're incredible. But they're that, as well as our house-made juices. So those are continuing to attach and increase. And also, when you look at our restaurants and at how they're positioned based on median household income in their markets, we're finding that the lower income consumers actually experiencing in those restaurants higher same restaurant sales than the rest of our cohorts of restaurants. So from that standpoint, it's encouraging to see that we are becoming more accessible for the lower income consumer and driving increase in sales in those areas.
How does the weaker results that you reported in the quarter, how does that impact your planning on future growth? Like, I know that you wanted or are planning to open as many restaurants next year, roughly as you opened this year. Is that still the plan?
We do intend to continue to increase the opening of our restaurants with at least 16% growth in restaurants in 2026. This year, we'll open at least 68 to 70 restaurants. And what we're seeing is that despite the challenges we see with the consumer today, we're very encouraged about the strength of the business and what we're able to offer. So our new restaurants that are opening or have opened in 2025, those restaurants are delivering average unit volumes above $3 million, which is above our chain average. And that really underscores the power of the brand itself, the excitement around the consumers as we come into new markets and existing markets, and gives us the confidence in our white space opportunities that we will continue to lean into our growth in new restaurants as we move forward.
Certainly new restaurants a big part of CapEx this year and next year, but where else are you investing?
We're always looking for ways to make our operations and our restaurants easier to run for our team members. So some of the investments we're making are in equipment in the restaurants to streamline operations, like our kitchen display systems, which works with our digital ordering systems on the back of the house, which supplies our digital customers. Those tools allow our operators and our team members to fill orders more easily and create a higher level of accuracy. We've also equipped our restaurants with Turbo Chef ovens. Many of our restaurants didn't have them, and in this year we made those investments. It streamlines cook times, creates better quality and efficiency, and simplifies operations for the team members overall. Our view at Cava is a happy team member equates to a happy guest and a happy P&L, and we're always looking for ways to reinvest in the business to drive that.
Let's talk P&L, and I'm just curious about, in your earnings, tariffs talked about how they have hit your or you guys talked about how tariffs have hit your restaurant level profitability through higher food, beverage, and packaging costs. Is that just the new reality and new normal that will stay with us for longer or perhaps forever? I'm just curious what your read on that. And then how does it play into pricing? Because I think you guys were still looking to limit price hikes now and also into 2026, but is that maybe up in the air?
Yeah, so tariffs have certainly been an evolving and an ever-changing area. Luckily, one of our values is to act with agility. So our team members on the supply chain side have done an incredible job in minimizing that impact as much as possible. But the tariffs did have about a 20 basis impact on our food, beverage, and packaging costs in the quarter. And I expect those to continue into 2026 as well. And what we've done from a pricing perspective is really try to minimize that impact. We took no incremental price in 2025 related to those incremental costs that we were incurring. We didn't believe we should put that on our guests and wanted to absorb that and try to continue to elevate our value proposition, which is quite high amongst our peers. And then as we think about it going into 2026, we're also going to be very mindful about price increases and anticipate very modest increases. Since the end of 2019 to the end of the third quarter, we've only raised price less than 10% below CPI or inflation and less than half of many of our industry peers. And that's something that we feel very strongly about and a trend we expect to continue to do despite the pressures we may experience on our input cost side.
Tricia, so I get that. So it sounds like you are being incredibly and have been mindful in terms of price increases on consumers. Having said that, if no price increases, but you did say that the tariffs have hit you guys on a couple different levels, does that mean margins take a hit? Or where do you squeeze costs out? Is it workers? Is it the supply chain? Where do you squeeze price, some of the cost of this out?
So certainly in 25, we took no incremental price related to tariffs. And in 26, there'll be modest menu price increases. That helps minimize any inflation that we experience on the labor side as well as the input cost side. And then there are other opportunities from an efficiency standpoint as we grow and scale that we will continue to deploy to minimize the impact on the P&L overall.
Tricia, your share price is down quite a bit this year. I'm just wondering, from a CFO perspective, is there room for shareholder returns? Like, are you thinking about buybacks? What's the measure to get your share price back up?
Well, what we've always said since the beginning is this is a journey and a long-term journey overall. And so while the share price can go up and down, we want to remain focused on the business over the long term and what that we can do to make sure that we drive that. And we stay focused on our strategy and committed to that. We'll always explore opportunities to strengthen and maximize those returns. And right now, we're just going to continue to remain focused on the strategy we have at hand, and that is opening and expanding the Mediterranean way across the country and running great restaurants every location, every shift, and deepening personal relationships with our guests with a high-performing team. You
have stores in more than a dozen states in D.C., so this question is dependent on geography, but in general, the labor market right now, our team has reported on Walgreens cutting pay for hourly workers after its private equity buyout. Is the labor market better for hiring people right now?
We're in 28 states in the District of Columbia across the country, and the labor market is one that we keep a very close eye on. And our focus is making sure that we're paying a very fair wage in every market across the country. So I work closely with our operations and people and culture team on a quarterly basis to evaluate our wages to make sure that we're in the top quartile of pay so that we don't have as much pressure on wage and can bring on high quality team members that can lead the future growth of our business overall.